really saying is if I can handle him, then I can handle any of you. That's really what he's saying. Now I'm here to talk about the new tax law changes for 2013.
Is there access to a microphone down there?
Do you want me to just talk louder?
Yes.
I can talk louder.
Just use a mic.
Very loud. I can use the mic too.
Or
Use the mic.
Is this better?
Yeah,
Hello? That's creepy. Okay, so I'm here to talk about the 2013 tax law changes. As you guys have been following Congress, you know that it's been up here and every which way. They made a bunch of, they say permanent changes, but of course they can change at any time.
yeah, that's good.
Let me tell you a little bit about our firm. Our name is now Larson & Company, and I'm in the Spanish Fork branch. We also have a branch in Sandy, Mesquite, Moab, St. George. Our firm focuses a lot on tax preparation and bookkeeping, right of services, payroll, that kind of thing. We also do some governmental audits, so we divvy, we work, do like Spanish Fork City's audit, things like that. Mostly, I work in the tax and the bookkeeping arena. I work a lot with real estate professionals. I feel like I know a lot about this, and a lot of it's because Matt's required me to learn a lot about it. But Matt's got about everything that you could do in the real estate world. He's got a piece in all of it. And so I've had to learn about that over the years. So we've done Matt's taxes since 2005, and we started doing his bookkeeping in about 2009. So I've worked with Matt for a lot of years. By now all of you should have this little paper we're going to talk about. So the first thing on the list is the Social Security tax. Does anybody know about this change? I hope a lot of you do. Does anybody get a W-2 from anywhere? Anybody yet? Okay, some people are still getting that. So the thing that changed with the Social Security tax is in 2010, the end of 2010, Obama decided that he would give a 2% decrease in Social Security to all the employees. So all of your paychecks should have went up by 2%, which we all thought was awesome. So he did that for 11, and he did that for 12, and then they took it away in 13. So it's a holiday is what they're calling it. So basically, instead of paying 6.2%, you were paying 4.2, but now it's back to the 6.2. So that's just something to be aware of if you have a W-2 or for Social Security reasons. The next one is a bigger one. So income tax brackets. They were going to fluctuate a lot. And so instead of fluctuating a lot, they just made one, they just hurt the high incomers is what they did. All the tax brackets remained the same. The 10, 15, 25, 28, 33, all of those remain the same. The 35 tax bracket, it's the one that changed a little bit. It goes from $398,000 up to $400,000, which is like couple thousand dollars for single people. And then for married filing joint, it goes from $398,000 up to $450,000. That's where the 35% tax bracket. And anybody over $450,000 for married filing joint, for $400,000 for single, are going to be paying a 39.6% tax. Now, keep in mind that this is taxable income. This is not AGI. So when Matt talks and he wants to get you guys a mortgage and do things like that, he talks AGI. This is taxable income. This is after your mortgage interest, after your, all of your deductions, your exemptions, all of that. So even though you think you might be in that bracket, you may not actually reach it. Does that make sense to everyone? Okay. So you're in that 39.6 tax bracket if you're over $450,000 for married filing joint. That's the new thing with this year. You guys can ask questions if you have questions.
What's what did you say? What's the acronym?
The AGI, sorry, adjusted gross income. So if you're looking at a tax return, it's the very bottom number on your front page. So if that number is over $450,000, then you'd be, taxable to that, the higher tax.
Is that $450,000?
$450,000. Mm-hmm. If that number, It would be the second page. There's a line that says taxable income. That's the number that you watch for to know what tax bracket you're officially in. However, a lot of people don't understand that tax brackets, like when you move to the 39.6 tax bracket, all of your income is not taxed at that. It's graduating, if that makes sense. So you're taxed at each bracket on the way up. So you're only taxed at that higher income for just that portion that you go over it. Does that make sense? Everybody's nodding yes?
So not all of it.
So not all of it. Not all of it's going to be taxed that higher. So all of the rest of your tax will be, all of the rest of your income will be taxed at the exact same rates it has been in previous years. The only thing that will be increased is just what hits over that rate, over that limit. The other thing that they changed this year is the capital gains. There was talk that it was actually going to be done away with and that everything was going to be taxed at ordinary tax rates. And it used to be short-term capital gains taxed at whatever tax bracket you're in. Long-term capital gains were taxed at 15% was the max. They were talking of getting rid of that, but they extended it. So if you were in the 10% tax bracket or the 15% tax bracket, and you have a long-term capital gain, you're at 0%. If you are in above the 15, but below this new 39.6, then you're taxed at 15% for long-term capital gains. The new thing they've done is if you reach the 39.6, if you're actually made it to that tax bracket, the long-term capital gains is 20%. So they've thrown this new criteria in there for the new bracket they came up with. Short-term is still going to be at whatever tax bracket you're in. You're still going to be taxed at that rate for short-term capital gains. Does all that make sense? Yes?
Lee, any definition, or what is the actual definition now for short-term compared to long-term?
Just 1 year. If you have to hold it for, it's exactly 1 year. So, yes?
Are they putting a 2 or 3% tax on capital gains for the healthcare bill?
Oh, we're going to talk about that. It's coming up. Yes?
Where's the short-term capital gain rates?
What are the rate? They're whatever bracket you're in. So if all of your income plugs you into the 25% tax bracket, that's what you'll pay for short term. Yep, it's taxed as regular income, short term is. Yes?
If you're in the 10 or 15% tax bracket, is there any limit on the amount of capital gain you can realize at 0%?
No. No. But you can't. Okay, so let me rephrase this. So you're taxed at 0% for that portion, but if now, okay, say you have $100,000 of capital gains. You may be taxed at 0% on the capital gains, but that $100,000 could have just bumped all your other income into a different bracket, and now all of your other income is now taxed at a higher rate.
So theoretically then, if you made $100,000 and it pushed you in that 39% bracket, you'd be paying 39% tax on that $100,000 gain, correct?
The gain you would only pay 20% on. But if it bumped your other income into the higher bracket, all of your other income is now taxed at
So
the
in
higher
other
rate.
words, then your capital gain could be taxed at a tiered level.
Yes. It doesn't. Yes. It's kind of confusing. Does it make sense though? Because a lot of people are like, I pay 15% capital gains, and I'm like, yeah, but it bumped all this other income up, and so now all your other income's being taxed higher. Plus, you have state taxes, which in Utah it's 5%. So now you're, so it's not straight. So when you're thinking of selling a property, call your tax advisor and say, hey, is this really, what is it really going to be? So that you know exactly what's going to happen. That makes sense?
So Lee, let's say for example you bought a property, but you use IRA funds to do that. How would that deferral tax impact your taxation?
When you ran it through an IRA?
Yeah.
Is the whole purchase and then the operating of everything in the IRA?
Yes.
Then you get into UBIT tax, which is totally different than the long-term capital gain.
Okay. But in any event, that's going to still push out your tax liability down the road, correct?
Yes. Yep. Okay. If you guys have questions, just pop up. The next thing is the fun one that all of you guys probably will be subject to. One that this lady over here just asked about. Obama decided to do this new Medicare, this new Obama Act, where he's this healthcare reform. So what he did is he said, we're going to do all this, and we're going to, give everybody free insurance or force them to be covered on insurance, and how are we going to pay for it? Oh, well, we need to make somebody pay for it. So part of the Reform Act is that you have to pay 3.8% will be added to any investment income that you have if you are over $200,000 for your individual or $250,000 for your joint tax return. You will be hit with this. Yes. So 3.8%, and it's for passive income, so investment income. It's not necessarily, I hear it called the real estate tax, but it's not necessarily real estate. It can be interest. It can be anything that's passive, rental income, anything like that's passive. So 3.8%, and it hits as soon as the individual reaches $200,000, or your married filing joint tax return reaches $250,000. And it's unearned. This is unearned income, is what they consider it. Yes.
Have losses that are carrying over. That's not me. It's just a friend.
Oh, of course.
Would that offset these gains, and would you then be subject to the 3.8? I mean, if you've got $500,000 in losses, you make $100,000, and you make this gain. Is it offset against your loss first, before you have that?
I believe that's going to be how it happened. I have not seen an actual tax form yet to say yes, that's how it's going to happen. But I believe if you have carry forwards like that, it's going to offset the gain before it actually charges the 3.8. That would be my understanding of
And
it.
I think categorically, like if you have ordinary income and you have a loss carry forward, it's got to be applied to ordinary income.
Correct.
Cross-pollinated.
Yeah. But I haven't seen a tax form yet. This is brand new. So yeah.
Just to clarify, so you're saying if you have 200 for an individual, 250 for a joint, passive income.
Passive income.
So just separated out the passive income, the 2.3 or the 3.8 is added to that. Separate. What if your total income is X?
Okay, so let me clarify that. So you get a W-2. Your wife gets a W-2 for $200,000, but then you make $100,000 of rental income, say. Okay, it's total household income, which is $250,000. So you did reach it, but now just the passive portion is taxable to the 3.8.
Total income hits 250.
Yes.
My income of 100 gets the bump.
Yep.
3.8. Hers is hers.
Yep. And I haven't seen a tax form yet because I'm curious to see. I'm sure there's going to be like which income you use first. I don't know how they're going to apply it. I'm sure it's going to be to their benefit. So I'm sure that that's how it's going to work. Yes.
Is flipping income or rental income considered passive?
Yes or no? Yes or no? Now, his question is flipping income. I get this question all the time. So basically, what the IRS says is if you do something and you do it on an ordinary basis, and you're earning income from it, it's active.
What is ordinary basis?
What is ordinary basis? So,
Being a sushi chef.
so every tax preparer is going to say this differently. I say, even if you do one flip every year for 5 years, that's ordinary. That is how the IRS, that's being conservative. That's how the IRS is going to see it. They're going to say, you're doing it all the time. Now, if you just randomly thought, I'm just going to do a flip just for fun, and you do one flip, and then you don't do any more, then I would say that could be passive. But if you start doing it, even if it's every year, even if it just depends on how often you do it and how, whatever it's called, repetitive it is, then it's going to become active income. And then your houses that you buy now become inventory instead of it being an actual real estate company. So it now becomes like inventory. Sorry, it's just an accounting terminology. Yes.
You're going to love this question. So let's say, for example, you haven't had significant flip income. Then this year you have like $500,000 in flip income because the previous 2 years you didn't have that. Is that going to set up a red flag with the IRS? How would you prevent it?
I wouldn't say it would set off a red flag. However, I would treat it as active. I would on a tax return I'm preparing. And did I answer your question though? So it is on a case-by-case basis. That's just kind of some general rules of how I look at it. Okay. I try to be more conservative on that one because, believe it or not, real estate professionals, or real estate people, the IRS thinks you guys are not straight. So I like to be kind of conservative with things like that, so that you don't get yourself into trouble. Does that make sense? Okay. Any other questions? Or move on to the next one. The other one that, I don't remember if I put this on the sheet or not. There's another tax on earned income. Has anybody heard of that one? It's a 0.9%. There's a 0.9% tax that's Medicare, and it's going to be tacked on any earned income over $250 and $200. Again, the same type of rule, but it's earned income. So if your flips were active, now they're going to be hit with this 0.9% Medicare tax.
In addition to or in lieu of?
Of the other Medicare,
Of the other 3.8?
the 3.8 will be on passive income.
Okay.
The 0.9 is on active income.
Got it.
So that's how we're going to pay for the Obamacare. Yeah.
What if you buy a house, okay, you get a house, and you flip it, give it to a nonprofit? Would that create a tax credit to offset some of these other taxes?
I didn't hear the full question.
You acquire a house, okay, you gift that house to a nonprofit. Okay, I assume that you could probably deduct the market value of that form of tax credit. Could that tax credit be used to offset some of these additional tax bases? Okay, you
Good
acquire.
question. Like, I'm just trying to, that is a good question. Because normally what happens, so when you give an appreciated asset to a charitable organization, this is just kind of a tax tip for anybody. If you are a giver, if you give to charitable organizations and you have a piece of stock or you have something that's appreciated value, and the charitable organization will take that from you, you actually can deduct the fair market value when you gave it to them, but you don't have to claim the gain if you didn't have any basis in it. So it's a win-win. It's kind of a tax tip. But I don't think that's what you were asking me.
Well, basically what I'm looking to do is, in the past I've gifted before. When I've had tax liability, I basically use it as an offset, so I wouldn't get hit with a tax bill.
Are you claiming as a charitable? Like it's a gift, or you?
Basically, it's filed as a gift, basically.
If it's a gift and it shows as a charity and it shows on your Schedule A of your tax return, then it would be decreasing before you got to your taxable income. It would be decreasing that.
You can't give charity
Other
into
businesses who have
profitability.
$300,000 gain, it's going to push you up to some of these higher thresholds. If you gifted a property that had a value of $100,000, you could use that $100,000 to get you in the lower bracket.
It will be in a lower bracket, but you would still be subject to the 3.8% on the ordinary income. Because the income is going to be taxed to you based on page 1 of your tax return.
So it's still
That 3.8 and that 0.9, they're going to be based on that. But your tax bracket is the second page, the line that says taxable income. Okay, what did you say, though?
He said you can't give away so much that you'll make yourself profitable.
That's true. That's true. Okay.
Where are we at? Just keep track of me.
Okay.
Oh, child tax credit. This was, it's a big deal to people who have lots of children, but they were going to they were going to lower the child tax credit to $500 and they kept it at $1,000. So they didn't change that. So it's not that big of a deal. Mortgage insurance premiums, I'm sure some of you guys probably have that. They were actually going to do away with being able to deduct those. I don't know why they decided to do away with it, but they extended it so you can still deduct mortgage insurance premiums.
So that's only if you have PMI.
What's that?
That would only be relevant if you have property with PMI.
Yes.
They did it because all the banks got rid of the second mortgages when you could do 80-20 loans or 80-15-5s. So as the banks foreclosed and took losses, because second mortgages were tax deductible, they didn't want to penalize the consumer, so that's why mostly everyone has loans with mortgage insurance now.
I see it a lot. On all the tax returns I prepare, I see a lot of PMI. So it wouldn't be a huge deal if you couldn't deduct it. So, yes?
Is that upfront mortgage insurance premium or monthly?
Either. Yep. Okay, the last one is section 179. Who knows what that is?
Chattel.
Anybody?
Chattel.
I know Matt knows.
Is it accelerated depreciation?
Accelerated depreciation. So section 179 of the IRS code states that if you have a piece of equipment, a piece of your roof, something like that, you can actually accelerate the depreciation and take it all in the first year. You don't have to take it over time. Basically, the IRS rule says that if you set a threshold, but normally any large item that you purchase that's over $600, you have to depreciate over time. You could set thresholds to be higher or lower than that, but normally it's anything over $600. You have to depreciate over time. You can't write off in the first year because they say that item will be beneficial to you for more than 1 year. So that's why they threw that out. So what section 179 does is it allows you to take it all in the first year.